Welcome back, Accounting 604. This is now video number 6 in Module 6. We have talked a fair bit about the behavior and some of the things that you will encounter when you look at long-lived assets. In this video, we now take all of that and basically take a look at, well, as you can see from the title slide, how we analyze these tangible assets. If these are the sort of behaviors we'll see, and we understand now how depreciation works and how that's reported to give us a net value of our long-lived assets, well, then how do we analyze this in terms of actual productivity, how management is treating tangible assets, how they are managing them, and of course some of the strategic decisions and initiatives that we may see in the future that we need to inquire about as analysts. And as we begin this, we'll take a look then at the PP&E footnote for Home Depot for the year ending 2023. And as you can see here in the upper table there, just take a look at the bottom there, net property and equipment. So there's PP&E, net of accumulated depreciation. You can see here that this, of course, in millions of dollars. At the end of 2022, or really the beginning of our period, we're talking about $25,199, and then throughout the year, it increases just slightly to $25,631. Now, the reason we bring this up is our first metric of analysis, the PP&E turnover rate, which, as you can see here, is essentially sales divided into average PP&E, which, as you might guess, you will need net PP&E beginning and end for the period and simply average them, right? And so what does this ratio actually attempt to describe? What is the level of PP&E? What level of PP&E is needed to generate a dollar of revenue, or also known as productivity or utilization? And another question becomes, how capital intensive is this company compared to its competitors? And simply, with all of its competitors, what about the entire industry space? What about, is it the type of an industry space that remains capital intensive or not? And so if you look at PP&E turnover for Home Depot, you take the equation, fit in the numbers we're talking about, we are talking about a PP&E turnover of 6.2. You see what's happening here? We take sales revenue, divide it into the average of beginning and ending net PP&E, and you end up with 6.2. What does that mean? It basically means a higher PP&E turnover because you can sort of see here as we look at what PP&E turnover looks like in this little graph for selected S&P industries, right? Biotech versus capital goods, much higher PP&E turnover, right? Or utilities or oil and gas with a much lower PP&E turnover. So as you can see here, PP&E turnover, obviously given a choice, a higher turnover is preferable because it implies a lower capital investment for a given level of sales. For a particular level of sales you're trying to accomplish, you can do it with less CapEx rather than more. Higher PP&E turnover increases profitability because it means the company can avoid asset carrying costs, and it frees up assets to generate operating cash flow. You'll notice that PP&E turnover is lower for firms and industries and very capital intensive industries like oil and gas, like utilities, even telecommunication, right? We have to build an enormous network in order to realize incremental income. And so you can sort of compare industries there, right? Now, the PP&E useful life, you can look at this as the ratio of average depreciable asset cost over depreciation expense. This essentially, if you basically are saying we're going to assume straight line depreciation and zero salvage value, then we can estimate the average useful life. How long before management is forced to look at, well, upgrading or replacing PP&E in order to keep it productive. In Home Depot's case, you can see that we are essentially taking the average depreciable asset cost, right? Average means, right, beginning and end divided by 2. Now, realize that there are a couple of asset classes we are removing from the depreciable asset base, and that would, number one, of course, would be land. Land with an indefinite lifespan has no depreciation calculation. It doesn't get any depreciation accrued against land, and construction in progress is the other. For Home Depot, it essentially means that the average useful life of its depreciable assets is 15.2 years. That should be an item for future consideration, whether or not it is appearing that Home Depot, for many of its long-lived assets, is approaching that threshold and really has to think about additional capital expenditures or CapEx burden. This yields our next ratio that we're going to look at, our PP&E percent used up. What proportion of the company's depreciable asset base has already been used up? In other words, transferred to the income statement as a depreciation expense, right? So you basically take the accumulated depreciation and divide it by the depreciable asset cost, and that is the percentage that is, from an accounting perspective, no longer productive. And for Home Depot, you can see here that is over half. It's about 63% used up. What does that mean? It means that, well, we're going to be looking at CapEx upgrades or replacements in the very near future, because knowing the degree to which a company's assets are used up helps you to forecast future cash flows for CapEx. You can see here in the second bullet point, if you find depreciable assets are 80% used up, then you're really talking very near future for a relatively high level of CapEx. Why is that? Well, we expect older assets to have more maintenance costs, to break down more frequently, and overall to be simply less efficient and less productive than newer assets, all other things being equal. What does that mean for us? It means that, first of all, PP&E turnover is not just a ratio. PP&E turnover is really a capital efficiency metric. It is a strategic key performance indicator, or KPI, that we really should be looking hard at as we consider what is management's decision on this. Do we look at this as PP&E is generally used up? Does management choose to expand capacity or simply sweat our existing assets a little harder? Which is also going to be reflected in the percent used up calculation, which of course foreshadows future CapEx burdens and expenditures. And finally, all of this has to be within the context of benchmarking against industry peers to really have a meaningful consideration. It makes no sense really to do a hard PP&E look and comparison for two companies in wildly different industries simply because the industry dictates, and for instance, barriers to entry, of competitive entry, will determine the level of CapEx expenditure far more than any other factor. Well, we hope that these are some of the considerations that you'll put in. You'll also see some of these things asked for in the homework, of course, and we will see you in the next and last deck in Module 6. See you in the next video.